Hey YouTubers, welcome back to my channel. In today's video, we're going to be talking about dividends and giving you a little bit of overview of what dividends are and go into a bit more detail on what to look out for investing in dividends. So while you watch the intro video, why not hit the like button so that it helps the YouTube algorithm to recommend this video to other people on YouTube. So, dividends are something that most UK investors, and that's because more so than other parts of the world, typically UK companies pay out more of their profits as dividends than other companies around the world, which makes sense as to why UK investors like dividends. So what exactly makes dividend investing so interesting? Well, clearly the best thing about dividends is essentially it's free cash, because you buy some shares in a company, the company then pays out a dividend. Now that can happen either once, twice, or even 4 times in a year. And basically that cash in form of dividends hits your bank account or your brokerage account, where you can then choose to spend it on anything or even reinvest it back in those same stocks. So let's take an example to put this into perspective. Let's say you buy a share and it's £1. Now in a couple of years, that share could have gone up to £2, let's say. Well, that's great. That means that you've doubled your money. However, at the same time, your share price could also go down. For instance, let's say it's fallen down to 50 pence per share. Now, that means you've just lost 50% of your money. But that's where dividends becomes interesting, because a dividend is paid out of the company and therefore it's no longer associated with the share price itself. This goes back to the fact that it's actually just cash that you can hold in your hand. So even though that a share price can go up or down, your dividend payout could still be the same. Now what makes dividends even more favorable during these current times? Well, it pretty much comes down to the fact that interest rates have fallen so much. Now due to the current interest rates in banks, it's not that favorable in order to save money in a bank, as currently you'll be getting less than 1% interest. Now don't get me wrong, saving in a bank is probably still the most safest way that you could ever save money. However, if you're willing to add some risk into your savings, dividends is a great method. And this is due to the fact that a dividend stock could exponentially go up over a 20-year period. Well, at least we all hope that they do. And at the end of the day, there's no sure bet that it ever will. However, looking at the market as a whole, this essentially is what has happened in the markets over the last few years. But one thing to remember is that dividends can be cut as well, as it's only paid out through the discretion of the management of the company. And essentially, management can only pay out the dividend in the company if they have the cash in order to pay it. Now, another reason why a company might choose to cut the dividends is because they want to reinvest that cash back into the company. And depending on what they're going to work on, this could actually result in the company going up in value, more than what your dividend would have paid you. So essentially cutting the dividends in order to reinvest in the company in a method that could make the value of the stock go up seems like a good option. However, there could also be things that are not so favorable as well. Say for instance, if a company decides to stop paying out their dividend because the company wants to buy back shares in their own company, or maybe the company wants to acquire another company. Now in these situations, it's not really a great investment for a dividend investor, because you don't really know if the value of the stock is going to go higher than what your dividend payment would have been. Therefore, this is why it's really important to understand and know more about the actual company that you're investing in, so that you can make an educated decision as to whether your investment is worth it or not. Now, when looking at dividend stocks, one of the key things to look out for is the dividend yield. So, what is the dividend yield? So let's say for instance you buy a stock for £1. Then that company decides to pay out a dividend of 4 pence. That now means that you just got a 4% dividend yield. Now every company will have a different dividend yield, and it's natural for a beginner investor to just look out for those companies that are paying out the highest dividend yield. But if the dividend yield is higher than the rate in which that the market is increasing, you need to have some alarm bells and be a little bit cautious, because there's usually 2 main reasons why a company would have a higher dividend yield than what the market rate is actually increasing by. Now, the first reason is that the business could just be really large and mature, and therefore doesn't have many growth opportunities. So it then decides to pay out more cash as a dividend. Now this is a great reason for the yield to be higher than the market. Now the other reason could be that the company is very likely to cut their dividends in the near future. Now this is obviously a bad reason to buy a dividend stock, because if you've made your calculated decision to buy a stock with, say, a 6% yield, and then it gets cut to 3%, so straight away you know that you're not going to get the same outcome that you initially calculated. And this is where we take into consideration the dividend cover. So this is where you look at the earnings from a company report per share, and then you divide this number by the dividend payout per share. So for instance, if a company reports earnings per share of, let's say, 50 pence, and then they have a dividend payout of, let's say, 25 pence, that means that the company is able to cover the dividend payout twice. This then gives a company some security over the fact that if their earnings does fall down a little bit, let's say it falls down to, say, 40 pence per share, the company would then technically still have enough money to pay out that 25 pence of dividends. But there is a slight catch here, because companies can only pay out dividends from cash. So it's not directly related to only the earnings, because a lot of companies run on a lot of debt. So they may have good earning reports, but if they're not sitting on a cash pile, they can't actually pay out a dividend. So then this is why it's also good to look at the free cash flow of a company as well. So for instance, if a company has a free cash flow of, let's say, £300 million a year, and they are paying out dividends to shareholders of, let's say, £100 million per year, this means that they have the ability to cover the dividend value 3 times in that year. And in those situations, pretty much seems like a no-brainer, right? Now, once you've understood the financial stability of a company, if they then decide to focus on buying back their own shares, this could be an even better opportunity, because just in case times do get rough, that company can then decide to reduce the amount of repurchasing and possibly divert that capital into paying out the dividend. Now the reason for this is because every company has it in their own interest to look like that they are a great investment. And one of those factors of looking like a great investment is by maintaining a steady or rising dividend yield. Now on the flip side, if a company had free cash flow of, let's say, £90 million, but is still paying out £100 million in dividends in a year, it's not rocket science. That clearly is not a good investment. As companies are scrambling around trying to find cash from other areas like cash reserves or selling up assets in order to pay out that dividend, and essentially devaluing the company. Now, there is also an easier way to invest it in dividend investments. And this is where in the US market, we can look at a list of companies that fall under a group called the Dividend Aristocrats. Now, these are companies that are in the S&P 500 that have paid and increased their base dividend every year for the last 25 consecutive years. Now, every year, this list is updated. And as of 1st of July 2020, there were 66 Dividend Aristocrats. Now, like I mentioned, in order to have that Dividend Aristocrat status as a company, you must be in the S&P 500, you must be increasing your per share dividend every year for at least 25 consecutive years, you must have a minimum market capitalization of at least $3 billion, and you must also have an average of at least $5 million in daily share trading value for the 3 months prior. Now, on a stock value level, these Dividend Aristocrats have actually underperformed compared to the whole S&P 500 in the last few years. However, on average, the dividend yield from these aristocrats alone have done better than the dividend yield of the whole S&P 500. Now, just like investing in the markets, you have the option of buying the aristocrats individually, but there also are Dividend Aristocrat index funds as well that you can choose to invest in order to spend less but have a little piece in the pie of every single one of those aristocrats. Now in UK, Dividend Aristocrats based on S&P have a different criteria as they select 40 of the highest dividend yielding UK companies within the S&P Europe Broad Market Index. and they must have a managed dividend policy of increasing or stable dividends for at least 7 consecutive years. Now, I've also put a link in the description below in order to get access to a spreadsheet that I made with all of the 66 US aristocrats from the US and the 40 aristocrats from UK. Now, I hope this has given you an overview of dividend investing and given you a little bit more insight of what you need to look into before investing in a dividend stock. And like I always mention, I have no financial background. So before you actually go and invest in any of these, I strongly advise you going and talking to a professional financial advisor. But at the same time, I'm going through this journey. And if you have any tips that could help me with my dividend journey as well, please feel free to leave a comment down below. I hope you enjoyed the video today. And as always, make sure that you hit the subscribe button. Don't forget to hit the bell as well, so that you get notified when my next video comes out. And as always, remember to like, share, and comment. See you in the next video.